Hello everyone, this is Austin Kuyrkendall from Carey Stamp & Company, back with another principled wealth moment. Today we're going to talk about bond ladders. It's not as complicated as it might seem. It's just a way to take income from a portfolio. And they work best when you know you have X amount of dollars that you might need every year over time. You know, we talk about kind of the 4% withdrawal rule. If you have $1 million in a portfolio, you can kind of take 4% or 40,000 a year and feel pretty comfortable. This is one way to kind of structure that and know exactly what you're looking to take out of a portfolio. So in this example, we have a four-year bond ladder. I'll get to what this fifth year is pointing to. But there's a few different options you can have with bond ladders. So the most simple one is, say you have one bond for every year. You have a bond that matures next year. You have a bond that matures in 2 years, and so on, 3 years, 4 years. You have some different options on what bond you want to choose for each year. You know, in the early years, we kind of stick to treasuries because there's not always a huge spread between treasuries and corporate bonds in that first year. So maybe you have a U.S. Treasury bond in your first year, but then you invest in some really high quality corporate bonds years 2, 3, 4. Maybe Apple, Amazon, Google, pick whatever. Just you want to probably prefer, if it's just one bond per year, you want them to be a safe company, a stable company. You don't want to go out on a limb and pick, one high yield bond, because if the company goes under, you lose your entire investment. But the whole idea is we can get these what's called a yield to maturity. So if we invested $100 in this bond in year one, and we let it sit there for 1 year and it matured in 2025, we can expect to earn 5% a year. Now, typically these percentages can go up. It's kind of an unusual environment right now because short-term interest rates have been higher than long-term interest rates. But over time, you're going to earn a percentage. These are annual rates. So if you had an Apple bond year 2, pays you 5.2% a year. These bonds, maybe they'll kick off some income, but really you can just expect to earn in 2 years from now 5.2% per year on that investment. So like I said, these are great if you know, hey, I want to invest $100,000 in this first year bond because I know I'm going to need $100,000 next year. And you can earn 5% on that investment in the meantime. And what a lot of people tend to do is, like we talked about, that 4% withdrawal rule for a portfolio. You can just let this bond ladder continue to roll. So next year when our treasury bond comes due, you've earned your 5% on that money. You've taken that $100,000 or whatever it is out of your portfolio. We can roll over either from other assets. Typically other assets will sell, maybe your growth stocks. They've done really well. You can trim from those values, put it into your fifth year bond ladder here, so that what you've done is you've taken part of your portfolio that was long-term growth, and now you know this section of your portfolio is going to need to come out for you to, spend money to live on. And you can be confident that these are going to hold their value. The only other thing I want to mention before I go, these don't have to be single bonds. Some people prefer 2, 3 bonds, so they'll go pick their individual stocks or individual companies. So, instead of year 2 being an Apple bond, you pick a handful of Walmart, Target, Home Depot. You can structure this in many different ways. And then there are different asset managers that provide actual funds. So you can find a bond fund where every bond in that portfolio matures 2 years from now or 3 years from now. They're going to have the year that they're maturing on typically within the name of the fund. And you can just put those bond funds in this ladder and they're going to turn to cash when that year comes due. But if you have any questions, feel free to reach out to us at Carey Stamp & Company. We'd be happy to talk more about bond ladders, what funds you can use, what bonds you can use. I'm Austin with Carey Stamp & Company. We're here to help. Feel free to reach out anytime.